The Bogleheads Guide to Investing by Taylor Larimore, Mel Lindauer, and Michael LeBoeuf is a detailed and accessible guide for individuals looking to understand and implement sound investment strategies based on the philosophy of John C. Bogle, the founder of Vanguard and the pioneer of index funds. The book emphasizes simplicity, discipline, and the power of compounding while debunking myths about investing that often lead people astray. The authors begin by stressing the importance of starting early. Time, they argue, is the most valuable asset for an investor. By starting to invest as soon as possible, even small contributions can grow into substantial sums due to the compounding effect. This early start allows investments to grow exponentially, highlighting how crucial it is to prioritize saving over consumption, especially in one's younger years. A key theme of the book is the principle of living below one's means. This involves controlling spending, avoiding unnecessary debt, and prioritizing savings. The authors recommend saving at least 15 to 20% of one's income to build a robust financial foundation. Debt is portrayed as a major obstacle to wealth creation, and they urge readers to pay off high-interest debts like credit card balances as quickly as possible. Financial discipline is presented as the cornerstone of long-term success. The book then explains the fundamentals of investing. Stocks, bonds, and mutual funds are introduced as the basic building blocks of an investment portfolio. Stocks represent ownership in companies and offer high growth potential, albeit with greater risk. Bonds, on the other hand, are loans to governments or corporations and provide more stability and income. The authors emphasize the importance of diversification, which involves spreading investments across different asset classes and markets to reduce risk. Diversification ensures that no single event or market downturn can devastate a portfolio. Asset allocation, the mix of stocks, bonds, and other investments in a portfolio, is highlighted as a crucial decision that should reflect an investor's risk tolerance, time horizon, and financial goals. Younger investors, for example, can afford to take on more risk with a higher allocation to stocks, whereas older investors nearing retirement should prioritize stability with a greater allocation to bonds. One of the book's central arguments is that index funds are superior to actively managed funds for most investors. The authors explain that index funds, which track broad market indices like the S&P 500 or the total stock market, consistently outperform most actively managed funds over the long term. This is primarily because index funds have lower costs, avoid the risks of poor management decisions, and reliably capture market returns. By focusing on low-cost index funds, investors can maximize their returns while minimizing the fees that eat away at their investments over time. To build a sound financial plan, the authors advocate setting clear financial goals and creating a roadmap to achieve them. Whether the goal is saving for retirement, purchasing a home, or funding a child's education, having a specific target helps guide investment decisions. They also stress the importance of an emergency fund, cash savings that cover 3 to 6 months of living expenses to protect against unexpected financial shocks like job loss or medical emergencies. Insurance is another pillar of financial planning, with the book advising readers to secure adequate health, life, disability, and liability coverage to safeguard their financial well-being. Taxes are a recurring theme throughout the book. The authors explain the benefits of tax-advantaged accounts like 401(k), IRAs, and HSAs, which allow investments to grow tax-free or tax-deferred. They encourage readers to take full advantage of these accounts to reduce their tax burden and accelerate wealth accumulation. Tax-efficient investing is also discussed, with strategies like placing tax-inefficient investments, e.g., bonds, in tax-advantaged accounts and tax-efficient ones, e.g., index funds, in taxable accounts. Additionally, they introduce the concept of tax loss harvesting, where investors sell losing investments to offset gains and lower their overall tax liability. The authors caution against common investing mistakes, such as emotional decision-making, chasing past performance, and overconfidence. Emotional investing, driven by fear during market downturns or greed during bull markets, often leads to poor outcomes. Instead, They advise readers to stick to their long-term plans regardless of market volatility. Chasing hot stocks or sectors is also discouraged, as past performance rarely predicts future success. The authors remind readers that predicting market movements is nearly impossible and that disciplined, evidence-based strategies are far more effective. Portfolio management is another critical topic. The book emphasizes the importance of rebalancing, which involves periodically adjusting a portfolio to maintain its original asset allocation. This ensures that investors buy low and sell high by trimming overperforming assets and adding to underperforming ones. Simplicity is a recurring theme, with the authors advocating for a three-fund portfolio consisting of a U.S. stock index fund, an international stock index fund, and a bond index fund. This approach provides broad diversification without unnecessary complexity. Frequent trading and speculative bets are discouraged, as they often lead to higher costs and lower returns. Retirement planning is covered in depth. The authors urge readers to save early and consistently, taking full advantage of employer-sponsored retirement plans and contributing enough to receive any employer match. They also discuss withdrawal strategies in retirement, recommending conservative withdrawal rates, e.g., 4% annually, to avoid outliving one's savings. Social Security is another important consideration, and they advise delaying benefits if possible to maximize monthly payments. The book concludes by summarizing the core philosophy of the Bogleheads. Investors are encouraged to focus on what they can control: saving rate, investment costs, and asset allocation, while ignoring the noise of market speculation and short-term volatility. Education is emphasized, with the authors encouraging readers to continue learning about personal finance and investing but to resist overcomplicating their strategies. The importance of community is also highlighted, with the Bogleheads forum serving as a valuable resource for guidance and support. In summary, the Bogleheads Guide to Investing provides a clear, actionable framework for achieving financial independence. It champions low-cost, passive investing through index funds, combined with disciplined saving, diversification, and long-term thinking. By following these principles, readers can build a secure financial future while avoiding the pitfalls of high-risk, high-cost investment strategies. The book's conversational tone, practical examples, and relatable anecdotes make it an engaging read for both beginners and experienced investors alike.